This is Retire Hour.
Welcome into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. I'm your host, Matt Goolsby, and we've got a full show for you this week, continuing this conversation about what's going on in the markets. It's a lot of volatility right now. We'll be talking with Jonathan McCoy, one of our advisors in Kansas City, and talking about how sequence of return risk, meaning, do you have enough money if the market starts doing what this volatile dance it's been doing? Won't want to miss that. Coming up then after Jonathan, we'll be talking with Larry Clefcorn, an advisor with Market Advisory Group Wichita, talking about, is the recession here already, or is it just is the likelihood increasing? What's going on with that? Larry will be joining us for a conversation there. After the bottom of the hour, we'll be talking with Corey Hebert about some of the interesting articles that have been going around about have there been cuts to Medicare and some of the navigators there with the health insurance marketplace. With Alex will be one of our attorneys with the state Eidelman Law Firm. We'll be talking about the risk of going in alone, the fact that he's been having a conversation or a interesting incident here with a parent that they're now getting the children involved. And then finally with Joshua Sikora, taxes are done. It's over. He doesn't have anything to do until next tax season. Or maybe if you've missed something, what maybe you should be doing there. So big show this week coming up here. But I wanted to kind of talk about this tariffs. There's a lot of uncertainty out there, and that's showing up in the market. That's showing up in the stock market where it's doing a lot of ups and downs, and one day it'll run up and the next day it'll pull back, and it's all over the place. And met with a gentleman several weeks ago. He's a professional here in Wichita, and he and his wife, they've got a pretty sizable nest egg, almost $5+ million. And he said, well, I'm not retired yet, and I don't want to move it until I fully retire. But now with all this volatility, he's sounding like he might be changing his tune. And I don't blame him. We had a conversation, and he said, man, I wish I'd have moved this to you sooner. The market's doing its wild things. His previous advisor or his former advisor, he had the gentleman, let's call him Dr. Scott. Dr. Scott had this conversation with his advisor, and he had asked his advisor to make him more conservative, and his advisor assured him to ride this out. He was in it for the long haul. But Dr. Scott was saying, well, if I'm going to be retiring in the next year or two, what is really the long haul? And these tariffs have really played chaos with the market, whether you're believing in what's going on or not. It's a fact that it's a reality, and it's impacting you one way or another. So I've been telling the dad joke lately of the markets are tariff-fied, and they're really concerned about all the unknown. Like I mentioned here earlier, Larry Clefcorn and I will be talking about, is the recession really, is it no longer really a likelihood that we're going to have a recession? Now it's just a matter of when it gets here and how bad. Be interesting to have that conversation with Larry. But switching gears, I was teaching a Social Security and tax class this week, and I had a gentleman come up afterwards, and he said, well, whether Trump eliminates the taxation on Social Security or not, I think I'm going to need tax advice. And we had this conversation after the class, and I'm a big proponent of eliminating the Social Security tax. I think it's a terrible double tax. And if they do eliminate it, I think it's going to open up a lot of opportunities for people to do more Roth conversions and better tax planning. But if they don't eliminate it, again, the Social Security tax, if you're not familiar with this, to me, it's almost a double tax, because the more income you have, or the more other income you have, the more it can cause your Social Security to be taxed or taxable. And it's often catches a lot of people by surprise. The gentleman that came up after the class, he said, man, this is more complicated than I really had envisioned or predicted. And when I asked him what was more complicated, he says, it looks like navigating these retirement issues, whether it's the health care, the taxation, when to take Social Security, do you need a will, do you need a trust? He said, these are all questions I hadn't really even pondered. I've just been putting money away into my company's 401k, into this bucket on the side, thinking I'm going to be okay with my Social Security, my pension, and this bucket of money on the side. But what was evident to him last night in this class, or this week in this class, was the fact that there's so many domino effects. If you take out too much money, it can cost you more for your Medicare. When you take out more money, if you're on Social Security, it has an impact on your Social Security taxation. His wife is considerably younger than him, 10 years plus younger than him. So he wondered if that had an impact on when he should take his Social Security. The answer was more than likely. All these different issues, they don't seem very big on them on the face value by themselves, but when they start adding up, it really becomes confusing. It really becomes overwhelming. And that was what I was having the conversation with the gentleman after the class this past week. The fact that you have to worry about all these different areas in retirement, it can make it challenging to figure out what you should be knowing before it happens to you. Did you catch that? There's things oftentimes here in retirement, whether you're getting ready to retire or whether you're transitioning into retirement or whether you've been retired for a couple of years. There's different things that can catch people off guard. And I've said it before on this show, I'll say it again. Most of the time, we meet with people after they have a costly mistake. And that's our whole motive and whole goal on doing shows like this, our other television shows, and our classes. We want to educate you and help you avoid these costly mistakes in retirement. And if you don't have someone that can help you with that, and you're thinking to yourself, man, I'm worried, I'm anxious, I'm concerned on what's going on right now, and I don't know how that impacts me. Does it impact me positively or negatively? Reach out and have a conversation with us. Just a 15-minute introductory call is all you need. 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can go over to our website at retirehour.com. And so with that 15-minute phone call, I've had several this past week having conversations with people. They just really want to have some general questions answered and see if they need to come in for a one-on-one. And so many people have been doing that, and I appreciate that. If you guys are listening out there, thanks for doing that. And if some of you guys are listening and thinking, man, I should schedule that 15-minute call just to get some questions that I've had off my plate or maybe just get more information on, that phone number again is 833-MAG-REPORT. Or 833, the letters MAG, report, or you can go over to that website at retirehour.com. Well, stay tuned. We're going to go up to Kansas City and talk with Jonathan McCoy about sequence of returns risk and what's that mean. Stay tuned. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. And it's changing very quickly around here with all the different things that are happening on in the world right now, whether it's Washington or the stock market reacting to the tariffs that Washington is pushing. So we're going to go up to Kansas City and talk with Jonathan McCoy, our lead advisor there. And, you know, you had a couple in this week that this market volatility was chief on their mind. It was at the top of their mind. Tell me about what was going on with this couple that you met with.
Well, so it's interesting. I mean, this isn't just a singular experience that we've had in the conference room in terms of this conversation around what does this market volatility do to impact people that are considering retiring, especially in the next, 4, 5, 6 years of their lives. And tying a few of these concepts that we hit on across many episodes of our show, thinking about sequence of returns, which is the direct impact of what the market does within those 3 to 5 years prior to retirement and 3 to 5 years after retirement, also known as that retirement red zone that Larry Clefcorn, our partner and advisor, refers to quite frequently. Understanding that if you take lower than expected rates of return or even losses around the time that you're planning to retire, that can have massive outsized impacts on the growth potential of your retirement portfolio, really for the rest of your life. And the concern there is people that are taking a hit in their retirement investment portfolios currently that are very close to the period of time where they're going to need to start taking income from those retirement accounts, because we've already seen over the last 20 to 40 years sort of pensions going the way of the dodo bird. You touched a little bit on Social Security benefits, and there's some risk to changes around Social Security coming up over the next few years, but specifically in the retirement investing landscape, understanding that not just diversifying across things like stocks and bonds, but diversifying across aggressive and conservative or even guaranteed safe type assets is one of the key focuses to portfolio management when you're very close to these retirement years, to avoid the risk that this sequence of returns, let's say the market goes down for the next 18 months to even 3 years, something similar to what we saw in 2008. And we're not forecasting that. This is not a prediction. We don't have that great of a crystal ball to be able to predict exactly what the market's going to do. But the key focus is just like the experience you had with the doctor that you mentioned in the first segment, Matt. It's, are we exposing ourselves to too much risk that the market may drop enough to have a significant impact on that lifestyle you're going to be able to live in retirement? And I think that's a reflection of a lot of people not really understanding the risks that they're exposed to before they sit down to talk to an actual retirement investment management firm such as ourselves, and working with our tax team, so on and so forth, to make sure that you've got the safe and the aggressive pots of money working together, as opposed to sort of that traditional buy and hold mindset that most people execute within their 401ks.
Yeah, I had to call a client this past week or the week before when all the market volatility started. They were watching the TV, and the S&P was down 10+%, and they're saying, "Oh my gosh, what's happening to my portfolio?" And they were not even down. They'd taken a withdrawal this year that was bigger than what the market volatility had dropped their portfolio. And there's strategies and tools you can use here. But back to your sequence of return risk, if someone comes in and says, well, the S&P 500 returns 8, 9, 10% over X amount of years, I'll be okay in retirement. The problem is that's not compounding. That's not every year. There's going to be a lot of
Right.
swings there. And do people, you've been an advisor for a long time now. Do people just not take money out of their retirement account when the market's down, or life goes on? They have to take that money out, right?
Bills still have to get paid. And, we talk about a strategy that we use called income allocation in terms of what bucket of money are you pulling from during good periods in the market, good periods of positive rates of return, those 8, 9, 10, 11% years, and the bad years of return where you might be getting negative 10, 11, 12, 15, 20, or even 30% in the highly aggressive equities portion of your portfolio. And when I first got into this industry, one of the biggest issues that I brought up was the concept around this 4% rule. If you only pulled 4% of your retirement portfolio value out each year, it should sustain you over a 25 to 35 year retirement period. The big issue there is, what if your retirement portfolio gets cut in half like it did in 2008? Or is that 4% going to be half the income? And can you afford to be able to live on half of the retirement portfolio income? Most of the time, that's not a reality. We've got to be able to sustain consistent levels of income throughout retirement, adjusting for inflation and changes in your lifestyle, so on and so forth. That's a much different conversation than just saying, oh, the market might give us, 7, 8, 9% per year. And during different periods of time, if you look at 1999 through 2009, the S&P 500 lost about 4.5%. So can you stand to lose 0.5% per year for 10 years in a row in your retirement? These things have happened in the past, and I think that sometimes as investors, we can get, unfortunately, lulled to sleep and have to be reminded by the market, unfortunately, sometimes, that we need to be setting up a more diversified strategy for how we're delivering that income in retirement. It's a much different conversation than those accumulation years when you're still saving and working and have, maybe time to recover.
And I think you hit the nail on the head there. Do you really have the time to recover? And we don't know how much time we're promised, right? And yes, the market comes back, but my question is the market done falling? I think what the recent volatility we've seen in the market, I think that's just due to a lot of the unknown and the uncertainty. I think we're still waiting on a lot of the data really to show up and reflect on either company spending, earnings, or impacts from the tariffs, right?
Yeah, that's exactly right. And, sort of the uncertainty around the tariff conversation and what's going into play. We're at the highest tariff rate that we've seen in about 100 years for us as a country. That can be obviously unsettling in terms of what's that going to do to expenses. We just had reports come out today that overall retail sales activity actually met, and even in some sectors of the economy exceeded expectations. And that's being seen as a reflection that consumers are seeing that these high cost items, you think of your appliances, that refrigerator, that HVAC system that you might need to be replacing in the next 3 to 5 years. A lot of people are sort of jumping the gun and getting ahead of what they fear might be these increased costs as we go forward as an effect of these tariffs. So people are making decisions financially already based on that uncertainty, and sort of getting prepared for a storm that we don't 100% know if it's coming, when it's coming, how it's going to affect us, and creating a sense of certainty and calm through these very turbulent waters is one of the biggest focuses that we have for our clients, is making sure that when we get into these worst case scenarios, because it's happening, there's going to be, not necessarily now, not necessarily 15 years from now, but there is going to be a major market downturn sometime. in the next 10 to 20 years. And we've gotten through lots of turbulence and volatility over the last 10 to 15 years since the financial crisis that, like you said, the market eventually recovers, but we've got to have sort of that life raft, sort of that reserve parachute that we can sustain our income needs through these market downturns. And sometimes that might mean a little bit of a cutback in the lifestyle and spending, but we don't want the market to be the tail that wags the dog in terms of determining what kind of lifestyle you're living in retirement, because otherwise, why not just keep working if you're just going to have to wait around to let the market recover to be able to live the lifestyle that you want?
Easy. No one said you got to keep working. You don't. That's not what people want to hear. So,
Right.
Well, if you're listening out there and you're thinking to yourself, my gosh, I could be retiring in the next couple of years, or I'm retiring this year. What's this market volatility going to do to my plan, or I need a plan, or how do I plan to handle this market volatility? If that's any of the questions that have been going through your mind lately, reach out and schedule a 15-minute call with us at 833-MAG-REPORT. That introductory phone number to call again is 833, the letters MAG for Market Advisory Group, then report. Or you can go over to our website at retirehour.com and schedule there. We'd love to have that 15-minute chat with you just by phone to make sure everything's going okay in your situation. Well, stay tuned. We'll be right back with Larry Clefcorn talking about, is the likelihood of a recession not really the question we should be asking? Is it when or how bad it's going to be? Stay tuned. We'll be right back. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. In fact, I've got Larry Clefcorn here, and we were just talking at the break. There was big news this week that China was going to stop buying U.S.-built planes, aircraft, and that's their first salvo, if you will, across the deck here.
And I heard Boeing response to that, and it was not enthusiastic.
You think? So you're referencing this is an economist, right? So that you've got an article here.
It's a reporter. He's kind of
Charlie
an
Gasper.
insider.
Okay. Yeah. Okay.
Many people recognize the name Charlie Gasper.
Yeah.
And he put out a report, and he did it on social media first, but he's saying, this is not what I'm predicting. This is what I'm hearing from my corporate contacts, business people and stuff, and that is the likelihood, there's no longer just a likelihood of recession, but they are saying, the corporate world, businesses, are saying that we are either in one or it's just around the corner. And they say the reasoning for that is that they are having to do some cutting back and not business as usual. And also that what they're seeing is the American consumer
Cut back.
is cutting back.
So this is an article that he's suggesting that the likelihood is, it's no longer a question of likelihood.
Right.
It's and kind of like the phrase, it's not a matter of if, it's a matter of when. Mm-hmm. And here it would be, it's not a matter of it's a likelihood. It's either how bad and when is it going to immediately show up. And we're already seeing the market be volatile. I mean, that's probably the market kind of telegraphing, looking forward that way. But really, we haven't had a quarter. We're just starting to come through earnings season, right? And so then we haven't really even seen the effects of these tariffs even show up really in companies.
Right. And when they do, it will. They're telling him it's going to lead to inflation. Well, my gosh, we're not even over the last inflation. We're going to pile another one on top of it, and then it'll evolve into stagflation, and that doesn't sound fun.
Well, when you're meeting with people that are coming in, they're obviously concerned. I mean, people I've been meeting with have concerns about what's going on right now.
Yeah, they are. I mean, it's topic number one, is the tariff things. I'm finding most of my clients are still supportive of the idea that we shouldn't be letting other countries take advantage of us. Why should they tariff us and we don't tariff them at all?
Interesting you should say that, because that's kind of the theme I've been seeing. There are some people that are absolutely opposed to it, and I know who those people are that I have as clients. But there's some people, like you said, they're in favor of it. And but it's going, just like he said in his address to Congress, President Trump, it's going to be a little bumpy.
Right. Yeah. I went back to look at that, and the word he used was disturbance.
Yeah, disturbance. Little disturbance.
Yeah.
That's right. Yeah.
So that was a clever way of warning everyone. So he fully expected that we were going to have volatility. Now, did he expect a 3,000 point drop one day,
Right.
and that sort of thing? I doubt it. But
Well, and going back to what you said, that the tariffs are going to have an impact on inflation, it's really going to put the Federal Reserve in a tough spot.
It sure
because
is.
if the Federal Reserve is trying to keep rates high-ish compared to what they've been to help slow inflation, but they're wanting to lower rates so they don't choke the economy, but then tariffs raise inflation. I mean, the expectation for inflation next year, and this is consumer driven, not economist, it's more than 6%, and like 6.7 is what I saw that. And so people are starting to worry about what inflation is going to do. And if the Fed has to fight this, call it a pullback in the economy by lowering rates, they're going to be kind of boxed in a corner because they can't really lower rates if inflation's still red hot.
Right. And then there's their other mandate of maximum employment. And that's not easy to do in an inflationary
Environment. Or even, like you said, stagflation environment. So is there things people can do to that are either nearing retirement, like you talk about all the time, the retirement red zone? Is there things people can do to maybe buffer that or weather this volatility?
The first thing that came to my mind is, wow, people really need to work with a firm who all work together, that collaborate. And when I say that, of course, I'm talking about the tax side of things. Has CPAs that will come in the room and join them. Has any other firm done that for them? The Medicare people, they even play a part in it, because just yesterday, clients that I've had for a while, her COBRA's running out, and she's going to need a bridge of marketplace insurance probably
To get to 65 when she can be on Medicare.
So we set her an appointment with our healthcare team.
This is something that is, again, changing rapidly, and we'll be talking after the break here with Corey Hebert about the article that was showing them the cuts to Medicare funding, or the navigators. And if you don't have a team that can help you, reach out and schedule that 15-minute introductory call at 833-MAG-REPORT. Or again, that phone number is 833, the letters MAG for Market Advisory Group Report. Or you can hop on over to the website at retirehour.com. We want to make sure you're getting the information you have questions about. Well, stay tuned. We'll be right back with more right after this. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. And with the new administration coming in, there's been a lot of changes. And in fact, there was an article this week, a popular Kansas news station published this article saying some Kansans may lose free help enrolling in health insurance because of federal funding cuts. And I'm sure your phone was just ringing off the hook. What are they? They're cutting Medicare. They're cutting Medicare. I haven't seen any cuts to Medicare yet, but I mean, kind of trying to still stay impartial here. But this article that came out, this was something. Tell us what's going on with this article, Corey. I'm not going to steal your thunder.
Yeah, well, whenever something like that comes out, we're going to have clients, and even around the office, I had probably about a dozen people here send me that article. And internally, you have people that work in this field.
They wanted to make sure you knew about it, but then also they probably wanted to make sure, what did you think about it? But this article that's saying they're cutting the funding for these navigators, right? It's what they're called, healthcare navigators, that help people enroll in all kinds of insurance.
Yeah.
They're cutting this, right?
Yeah, well, with those two groups of people that are sending that to me, I have people that they work adjacent to that industry here. They work alongside me, even though they don't do the stuff that we do. And have my clients or prospects that are involved in this field. And you would think that the people that work alongside, they would look at that and maybe not be so concerned, but they hear this lingo every day, and still a headline like that can definitely cause a lot of fear and anxiety whenever it comes to here more specifically. Medicare is a small portion of it. The marketplace or the ACA insurance is a much larger portion, and that's definitely a headline that jumps off the page at you, that people are going to lose all of this free help from navigators signing on to ACA policies.
I can almost hear the disdain in your voice when you say navigators. So I think that needs some explaining there. These navigators, they're not licensed individuals. They're almost, and sometimes they can be volunteers. Sometimes they're paid. That's what this funding cut's happening here. But you talked about the ACA, the Affordable Care Act, sometimes referred to as Obamacare. These are people that are helping people enroll in that. And truthfully, the numbers, the government is claiming the numbers aren't that impressive for the money they're spending, and they're cutting this.
Yeah, absolutely. And you hit on a very important part right there, Matt. And the very first question that I have when I look at this, that whenever it gets closer to the fall, that there's at least a week to a week and a half where you don't see me at all.
I think you take a vacation. I've seen rumors of that. I don't know.
Promise you I'm here.
You are.
I'm in my office. I return my phone calls.
Back-to-back meetings.
But what that is, even before the meetings for enrollment start, is it takes us, and me and my team, weeks to get certified and learn and test over all of the changes that are coming to the new programs. And whenever you have somebody that is a navigator, they have their internal trainings and there are things that they do as a company to train on this. But it does raise the question of the help may be free, and people think, well, I'm not talking to a salesman, so this must be better. But when you're talking to an agent, you know that you're talking to somebody who has passed all of these tests, is certified with a bunch of companies, to be able to present these options in a healthy and beneficial way to the client.
Kind of reminds me of those old commercials on TV where, there'd be an emergency and some guy would step in and like, oh my gosh, are you a doctor? No, but I did stay at a Holiday Inn Express last night. So it's not the fact that this navigators and the cuts to this funding. First of all, do you think it's going to have a big impact on people enrolling? I don't.
Matt, I highly doubt it.
People need insurance. They need insurance. And there's tons of healthcare advisors out there. I'm not trying to diminish you guys or make sure you sound like a dime a dozen, but the people that you're helping, sometimes they have assets, sometimes they don't. Sometimes they need to be on the Affordable Care Act. Sometimes they're need help with coming off COBRA and going to Medicare. This is probably, like I said, probably not going to have a big impact on enrollees. It's a headline meant to grab attention.
Yeah, and Matt, there are two really big things in this headline that I do want to go ahead and point out. Number one, a lot of people honed in on the word free. You're going to lose this free resource that the state gives you. Curious, do you know how much we charge for a consultation?
$5.99.
Our consultations are always free. You're never going to be charged anything to come in to meet with one of our insurance advisors. And in addition to that, one of the biggest things that this group pushes is the fact that because we're not salespeople, we're going to go through all of your options and pick the best one for you. Which, Matt, here at our shop, I can speak for us, we are licensed with all of the major ones. And if we're not licensed, we have a commitment to get people the resources to get with the company that they need to be placed with. But that is something that enrollees need to be asking whenever they go to meet with an agent. Hey, there are 10 options up here. How many of them are you licensed to represent?
And sometimes those people, those Medicare healthcare advisors, are only licensed or representing one company. And then that's even worse or in my opinion, it's worse for the enrollee or the healthcare client. But what's the second thing you want to hone in on this?
That was the second. So it's the free, and then the fact that we are that independent resource. Well, I know a lot of people that do this across the state, and almost all agents are going to be licensed independently. Now, you're absolutely right. There is that due diligence that if you are shopping for these healthcare plans, you need to do, because there are people that maybe are only licensed with one or two. But looking for that good agent, you're going to find plenty of options people that have all those options.
And I can't speak for every healthcare or Medicare advisor, but normally speaking, there's no charge for them to go in and talk to someone. So when this headline's saying some Kansans may lose free help, how?
Yeah, Matt, there's one of two different ways that an advisor can make money. You can either A, charge a fee to sit down with the client and forego any commission from an insurance company. Or you can have a $0 meeting with the client and accept commission from an insurance company. But one of the beautiful things about these government programs are it doesn't matter if you pick option A or option Z, the amount of commission that an agent will be paid is regulated by the federal government. So there really is no horse in the race, so to speak.
So this article is probably more about grabbing headlines than it is really about the fact that a lot of people are going to lose access to getting help.
Now, I really think that the people that they interviewed for this article, they, in their hearts, they have true intentions of helping individuals.
Sure.
And I'm not going to take away from that. The phrasing in it and the big scary headline that you're going to lose so much is being taken away from you. That's just not 100% accurate.
You're not seeing it. So, well, if you're out there listening or watching thinking, man, I really could use someone to help me understand that transitioning from my group insurance or my spouse's group insurance over to Medicare. And if you don't have someone that you can rely on to get answers to that complicated mess to navigate, reach out and schedule a 15-minute introductory call at 833-MAG-REPORT. Or again, that phone number is 833, the letters M-A-G, report. Or you can go over to our website at retirehour.com. Well, stay tuned. We'll be right back with Alex Robinson talking about the risk of going it alone. Stay tuned. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. But I mentioned we don't just do this show. We also have a TV show. And we also do a lot of in-person classes. And I was teaching a Social Security and tax class this week, and on Tuesday night, had a gentleman come up to me. This was out at the Butler County Community College out in Andover. Had a gentleman come up to me afterwards, and he said, man, and I was talking about this in the first part of the show, man, this is more complicated than I thought. You know, I thought I had this taken care of, that taken care of, but at least I have my will taken care of because I've written all that down where my cars go and everything, and my wife has it. That's not probably going to work, is it?
I mean, if he did it himself, there's a very good chance that it's not going to work. I see all the time people who are very confident that they don't need anything, you know, whether they're a client of yours or they've gone to a workshop or whatever it is, and they're like, oh, I've got a will. And I'm like, well, I'd love to see it. And they're like, here, I've got it with me just to prove to you I know what I'm doing. And I look at it and it's handwritten. Well, in Kansas, that's called a holographic will, which means that it's not valid.
I just thought it was who Captain Picard wanted to leave the holodeck to.
Right, yeah, no, okay. That's not how it works, unfortunately.
That's not how it works? Yeah. Okay. So holographic wills are basically ones that you just handwrite out.
Right.
They're probably not witnessed or notarized, right?
Well, this one was witnessed, but it doesn't matter because if it's handwritten, it's not valid in the state of Kansas. And so there's a lot of what we call formalities that go into a will and a lot of formalities that go into all of your estate planning documents. And if you don't meet all of those requirements, then the will isn't valid anymore. And so if he died, you know, then his wife would not get everything outright. You know, she would have to figure out, well, 50% goes to the kids and, you know, what are we going to do? And all of a sudden the plan that you thought you had in place isn't actually a plan at all and doesn't work the way you want it to work.
What's kind of the craziest thing you've seen on people bringing in things? And I know I'm sure that could last all hour, but just some of the things that come to mind here. I mean, you ever seen anyone just like scratch things out and just write it in their own word? Is that valid?
No. So if you scratch out anything on your will, you know, whether it's a typo on a name or the date, or, you know, your daughter got married and now her last name has changed. If you cross out anything, then there's no way to prove who did it or when it was done or anything like that. And so any will that has any markings on it at all is not valid anymore.
So kind of coming back into the topic of the risk of going it alone. When you say the risk of going alone, trying to draft up your own documents, trying to copy and paste things. I mean, I've seen things myself over my career where you had someone that tried to put together a will or a trust hastily, and there's all kinds of gaps in it, or there's, worse yet, unintended consequences.
Yeah, I mean, one of the most common ones that we get is someone says, "Oh, I already put my daughter on my house. Like, she's already a joint owner on the house, so that if something happens to me, it's hers."
Well, what happens if something happens to her?
Well, there's that. There's also, she could sell it if she wanted to. No one wants to think that, but if they're in dire straits financially, they can force you to sell the house. Or when you die, they don't get that step up in basis.
True.
So when they sell, they're looking at a capital gains tax that they wouldn't have otherwise been charged with.
So back to that scenario, if you put your kid on your house, what if your kid's married, and you use the example of a daughter, what if your daughter's married and the spouse decides to divorce that daughter? Does it kind of put your house in play as in the marital estate?
It can, for sure. Kansas is a very complicated state when it comes to divorce. And so it can certainly put it at risk. And that's not something that we want to see.
And so there's ways where you can, normally whatever the method or the outcome someone's trying to get from putting your kid or a family member on your house, there's normally another avenue, whether it's TOD, trust, irrevocable trust. There's normally other avenues that you should go before just putting your kid on your house.
Yeah, absolutely. Because again, there's all these unintended consequences. And that to me is kind of the thing we're trying to avoid, is that we want everything to be thought through. And if you say, "Hey, I'm good with whatever this result is," that's fine. But we have a lot of people who say, "Hey, I'm just going to give everything to my oldest because, he's joint on my bank accounts. I know he'll take care of everyone." The problem is he doesn't have to. And if he's in the middle of a divorce, or he finds out he has cancer or has some other issue that he needs money, he then gets all of it and gets to say, "Everyone else, see ya, I'm going on a vacation."
Well, and where my mind went, yes, you have that scenario where they don't have to share with the kids. But sometimes, if mom and dad have a big IRA, say mom and dad have $1 million in IRA and there's 2 kids, well, if the $1 million all goes to that one kid because he's the oldest and more responsible, he's going to pay more in taxes on that IRA than if it had been divided between 2 people.
Right.
So my mind, I guess the money guy goes to the financial impacts. Yeah. You're the lawyer. You go to the nefarious actors that you're trying to keep people protected from.
Well, and that's kind of the point, is there's a whole range of issues that can occur if you do things on your own, because we don't know what we don't know. So you do documents, you're like, "Hey, this looks good to me. I think this is doing what I want it to do." And then if you're lucky, you come in and talk to an attorney who tells you, "Wait a second, this isn't going to go the way you want it to." And if you're not lucky, you or the other people in your life pass, and you find out the hard way when it's time to start transitioning resources.
Yeah, you and I'll have to talk about next time on the show that story that you and I talked about yesterday, where it's just, it was interesting, the fact, it was fortunate for the surviving spouse that there was no kids involved, because that could have been big time.
Absolutely.
So if you're thinking to yourself out there, well, I don't know if I'm covered, or I don't know if my estate plan is really the right plan for me, or I don't even know what my estate plan does, or worse yet, I don't have an estate plan. If any of those questions or any of those statements resemble what's going on in your situation, reach out and give us a call at 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can hop on over to the website at retirehour.com. Because if you schedule that 15-minute call, just introductory, just having it wherever is convenient for you, we want to get to know you and what's going on in your situation, and of course, help you get answers to the questions you have. Well, stay tuned. We'll be back with I'm hoping, pleasantly surprised Joshua Sikora, because taxes are done. He doesn't have anything to do until next tax season, right? Stay tuned. We'll be right back after this. All right. Hallelujah. Glory. Hallelujah. Tax day has come and gone, right? I mean, you don't have anything to worry about until next tax season.
Yeah. I'm really kind of glad not many people watch us on YouTube, so they can't see me rolling in here with the swim trunks and hitting the pool right when we're done recording.
Well, you have not rubbed in your sunscreen all the way, so you gotta get
Oh, okay. Thanks. I don't want to be blotchy later.
So taxes are done, or, if people filed an extension, they've got till October 15th, but tax day has come and gone. What are you going to talk about with us? I mean, you probably have nothing to share with us at all, because
probably not. So I mean, a few people reached out to me after we filed their return, and the common theme was, well, there was two pieces. Either A, hey, we forgot this document or this additional stack of documents. What do we do
Additional
now?
stack of documents.
Yeah,
I forgot I had 15 rentals I didn't tell you about.
Yeah. And then the other one is that, hey, you know, you filed everything we gave you, but since then we've received corrected
Documents.
like 1099s is you know what happens a lot. What do we do now? And so, you know, people are, do we just wait for the IRS to reach out to us? Do we fix it now? And so, we fix it now. We want to go in and we may want to file an amended return to correct those, to let the IRS know. Sometimes it's a small enough difference. It's fine to wait till the IRS reaches out, because whatever penalty they're going to assess isn't really worthwhile to go through the cost of amending return. But sometimes we're talking about bigger stuff, and sometimes some of that stuff is stuff that the IRS may not be aware of. Where, let's say they corrected one of your brokerage 1099s, there's additional capital gains, but all the IRS is aware of is the proceed portion. If you don't amend that return, they're unaware of what those investments were worth to you. So then you end up paying tax on the whole sale, not just the gain, or they're not aware of the loss. So that's an important place where those amended returns comes in, where you're sharing the complete picture with the IRS before the IRS reaches out to you. Keep those penalties low and get that fixed.
Everyone loves when the IRS reaches out to them. I mean, they send those wonderful, beautiful letters, those nasty grams.
I mean, they got little hearts on there. Hey, the IRS loves you.
Well, let's don't go that far. But so what is there a timeline for an amended return? I mean, do you have to have it in by a certain time? I mean, April 15th is tax day and October 15th is the extension deadline. Is there an amended deadline?
I know this will shock you, but if you owe additional taxes, there is no deadline, which means whenever you do find out about it, whether it's a week from now or 10 years from now, you're supposed to go fix it. If you want money back, you know, let's say, you know, there's a capital loss you didn't know about, and so you'd get a little bit more money back. You have 3 years from the due date of that return to get that done. And if it's, you know, 3 years and a month, well, the IRS thanks you for your patriotic contribution. But sometimes amended return isn't about fixing things that went wrong. Sometimes it's that you found out there's a better way to do things. And that's where we work with clients who have more things going on than just, you know, a W-2 and a little bit of interest. We work with them to identify places where it makes sense to amend returns because there's a better way of putting their things together. We do, you know, proactive planning, not just like the Roth conversion stuff we talk a lot about, but people who have business activities going on. Maybe there are things that they are missing because they're working with someone who's just putting that return together, a preparer, instead of an advisor who can provide that bigger picture look of things. And maybe it makes sense to change the entity type, or maybe it makes sense to break out things so that you can pick up different expenses on a more aggressive basis, so that you're able to see that cash in your pocket today versus 7 years from now. But unless you're working with an advisor who can address these things in a timely basis, because we're talking about that 3-year window, then that opportunity might go by the wayside.
Well, as fascinating as all that is, I have to ask you about Social Security taxation, because I've been getting a lot of questions in my classes I've been teaching. What are you giggling about? Just shut up. This is a question I've been getting. I mean, if they do eliminate the tax on Social Security, what the president keeps calling for, is people then don't have anything to worry about. But I replied back to the gentleman and said, well, to me, you could almost do larger Roth conversions if you don't have to worry about the Social Security being taxed. And really, even it's a plus and a minus there, because it's going to hurt Social Security not having that tax go into it. But if people have these retirement accounts and they want to do Roth conversions, if they change the taxation on Social Security, which I hope they do, because it's a very regressive tax, double tax in my opinion, there's going to be a lot of opportunities.
There's going to be a lot of opportunities, but with those opportunities, I think comes a lot of pitfalls. And if people aren't working with tax professionals who are keeping up on these changes in the tax law, because it's not going to be just that one issue. They're going to do that one thing, you know, relieve the tax on the Social Security, but they're going to do something else over here. And if you're not aware of these two things and how they're playing together, you're likely to pay, you know, more in taxes or more in some other missed opportunity or penalty or extra taxes or something.
You know, I'm over here being excited and jubilation because, you know, it will open a lot of planning opportunities if they do eliminate that. You're over there going doom and gloom.
It's not doom and gloom. It's take advantage of the opportunities you can, but make sure you're not getting, there's not some gotcha that's hidden.
And most of the time, people don't understand that gotcha until it gets you.
That's right.
And that's when we meet a lot of people, and we're trying to make sure that happens, or they get information about this before it happens, so they can either protect themselves or do something about it.
Rarely are tax surprises pleasant.
I don't know. You gave me one this week. So if you're listening to this and you're saying, man, I don't know what's going on in my tax situation. I don't know what I need to be doing. I don't know what I don't know. Someone said that earlier on the show. Reach out and schedule a 15-minute introductory call with us at 833-MAG-REPORT. Or that phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can head on over to our website at retirehour.com. Well, that's all the time we have this week. Thanks for tuning in. We'll see you back here next week.
Unless otherwise indicated, all client names have been changed to protect their identities. Investment advisory services are offered through Foundations Investment Advisors LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns are not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in the states where it is registered or excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by security regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. Legal services are offered by Edelman Law Firm. Tax services offered by Market Tax Services. Market Advisory Group does not provide legal or tax advice. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. The guest commentators featured in this show are not investment advisor representatives of Foundations and do not provide advisory services. Market Advisory Group does have several investment advisor representatives that can provide such services. This is not endorsed or affiliated with any U.S. government agency, the Social Security Administration, or associated with any federal Medicare program. We do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal/tax advisor to be sure a Roth IRA conversion fits into your planning strategies. All rights reserved.